Question 1. Which of the following best describes the primary purpose of facultative reinsurance? A. To automatically cover all risks within a treaty agreement without individual risk assessment. B. To provide reinsurance for a single, specific risk or group of risks that are not covered under an existing treaty. C. To cover an aggregate of losses for the ceding company regardless of individual risk assessment. D. To reduce the insurer's premium by requiring multiple insurers to share the coverage on the same risk. Answer. B. Explanation. Facultative reinsurance is a type of reinsurance where the reinsurer provides coverage for a specific risk or group of risks that the ceding company may have underwritten. Unlike treaty reinsurance, which automatically covers certain types of risks, facultative reinsurance is purchased on a case-by-case basis. The ceding company will select individual risks to be reinsured, allowing them to tailor their reinsurance strategy. This is critical when a risk is too large or too unique to be included in a treaty, while the options are incorrect. A. This describes treaty reinsurance, which automatically covers risks within the treaty parameters. C. This describes an excess of loss reinsurance or other non-proportional types, not facultative. D. This is a misinterpretation of the concept of shared risk, which is more relevant to proportional reinsurance arrangements. Question 2. Mr. Anderson is a ceding insurer who enters into a quota-share reinsurance agreement with a reinsurer. Under this arrangement, Mr. Anderson cedes 40% of his premiums and losses to the reinsurer. If Mr. Anderson's company collects $1 million in premiums for a specific line of business, how much premium is transferred to the reinsurer? A. $200,000. B. $300,000. C. $400,000. D. $500,000. Answer. C. Explanation. In a quota-share reinsurance agreement, the ceding insurer, Mr. Anderson, agrees to share a fixed percentage of premiums and losses with the reinsurer. Since Mr. Anderson is ceding 40% of the premiums, the reinsurer will receive 40% of the $1 million collected. Calculation. 40% of 1 million equals 0.40x 1 million equals $400,000. $400,000 of the premiums are transferred to the reinsurer, while the options are incorrect. A. $200,000 represents 20% of the premium, not the agreed upon 40%. B. $300,000 does not align with the specified 40% share. D. $500,000 is overestimating the cession percentage. Question 3. Scenario-based. Mr. Charles, an insurance executive, is negotiating a reinsurance treaty with a reinsurer. During the negotiation, Mr. Charles realizes that the reinsurer insists on including a loss limitation clause that will prevent the reinsurer from paying out any claims above a certain threshold, regardless of the actual loss. What should Mr. Charles consider before accepting this clause? A. The clause is standard in all reinsurance contracts and cannot be modified. B. The clause may limit the reinsurer's ability to pay claims, which could significantly affect Mr. Charles's company's risk exposure. C. The clause allows for more flexibility in terms of premium reductions, which Mr. Charles should prioritize for his company. D. The clause will increase the premiums Mr. Charles needs to pay, making it less desirable option. Answer. B. Explanation. The loss limitation clause described in the scenario indicates that the reinsurer will not pay claims above a certain threshold. Mr. Charles must carefully assess how this clause could affect the company's risk management, as it may limit the coverage provided by the reinsurer in the event of significant losses. The main concern is whether this clause will leave the ceding insurer, Mr. Charles's company, exposed to greater losses anticipated, especially for catastrophic events or large-scale claims. While the options are incorrect, A. While loss limitation clauses may appear in some reinsurance contracts, they are not universally applicable and should be negotiated carefully. C. Although flexibility in premiums is important, reducing premiums at the cost of significant coverage limitations may not be wise strategy. D. The increase in premiums is not the concern. The risk of underinsurance due to the loss limitation is the critical issue here. Question 4. In a surplus share reinsurance arrangement, what factor primarily determines the amount of risk that the reinsurer will assume? A. The total value of premiums collected by the ceding company. B. The size of individual policies in relation to the ceding company's retention limit. C. The level of claims activity in the industry. D. The number of reinsurers involved in the arrangement. Answer. B. Explanation. In surplus share reinsurance, the reinsurer's participation in a policy is determined by the amount of risk exceeding the ceding company's retention limit. The reinsurer assumes the portion of the policy that exceeds the ceding company's retention, which is typically a specific percentage or value of the total policy. This allows the ceding company to offload excess risk, particularly for larger policies, while other options are incorrect. Premiums collected do not directly determine the reinsurer's share of risk in surplus share reinsurance. C. Industry-wide claims activity does not specifically influence surplus share agreements, which are based on individual policy size. D. The number of reinsurers involved does not affect the determination of the risk shared in surplus share agreement. Question 5. Which of the following best defines retrocession in the context of reinsurance? A. A reinsurer transferring a portion of its risk to another reinsurer. B. A reinsurance agreement where the ceding company shares risk with a direct policyholder. C. A type of reinsurance where the reinsurer assumes all of the risk without limitations. D. A mechanism where the ceding insurer assumes risk back from the reinsurer. Answer A. Explanation. Retrocession is the practice where a reinsurer transfers some or all of the risk it has assumed to another reinsurer. This is typically done to manage exposure to large or catastrophic risks. Retrocession helps reduce the overall risk that the initial reinsurer faces, thereby spreading the potential for financial loss among more parties. Why other options are incorrect? B. This describes a direct insurance agreement rather than reinsurance arrangement. C. This could describe excessive loss reinsurance, but not retrocession. D. Retrocession involves reinsurers transferring risk, not the ceding insurer transferring risk back. Question 6. Which of the following is a primary purpose of using catastrophe modeling in reinsurance pricing? A. To predict and calculate the exact cost of claims for each policyholder. B. To estimate the potential impact of catastrophic events on the reinsurer's portfolio and pricing strategy. C. To calculate the exact premiums the ceding insurer must charge to remain solvent. D. To assess the likelihood of reinsurance disputes over claims. Answer B. Explanation. Catastrophe modeling is used in reinsurance to assess the potential impact of catastrophic events, such as natural disasters, on the reinsurer's portfolio. This allows for better pricing decisions by estimating the frequency, severity, and financial impact of these events. The model helps the reinsurer determine how much coverage to offer at what price and how to manage their exposure to catastrophic losses. Why other options? Incorrect. A. Catastrophe modeling does not focus on exact claims for individual policyholders, but rather on aggregate risk from catastrophic events. C. Premium calculations for solvency are influenced by broader risk assessments, not just catastrophe models. D. Catastrophe models help in risk management but are not designed to predict disputes over claims. Question 7. Mr. Jenkins is negotiating a treaty reinsurance agreement. The treaty includes a clause that states the reinsurer will pay claims only if the losses exceed a specific threshold per event. Which type of reinsurance is Mr. Jenkins negotiating? A. Quota share reinsurance. B. Excessive loss reinsurance. C. Surplus share reinsurance. D. Facultative reinsurance. Answer B. Explanation. Excessive loss reinsurance is a non-proportional form of reinsurance where the reinsurer only pays claims that exceed a specified threshold, often referred to as the retention or attachment point. This type of reinsurance is used to protect the ceding company against large, unexpected losses, and it typically applies to individual events per risk or aggregate losses. While their options are incorrect, A. Quota reinsurance is a proportional arrangement where the reinsurer shares a percentage of both premiums and losses, not based on a threshold. C. Surplus share reinsurance involves sharing risk based on policy size, but does not typically operate with a threshold. D. Facultative reinsurance involves individual, specific policies and would not involve blanket clauses related to thresholds across events. Question 8. What is the key difference between proportional and non-proportional reinsurance? A. Proportional reinsurance is based on a fixed percentage, whereas non-proportional reinsurance is based on the total value of premiums. B. Proportional reinsurance shares both premiums and losses based on a fixed percentage, while non-proportional reinsurance provides coverage only after a specified loss threshold is exceeded. C. Proportional reinsurance covers catastrophic events, while non-proportional reinsurance covers losses. D. Proportional reinsurance is used primarily for life insurance, while non-proportional reinsurance applies to property insurance. Answer B. Explanation. Proportional reinsurance involves the sharing of both premiums and losses between the ceding insurer and the reinsurer based on a fixed percentage, such as in quota share or surplus share arrangements. Non-proportional reinsurance, such as excessive loss reinsurance, involves the reinsurer providing coverage only for losses that exceed a specified threshold, the retention limit. This type of reinsurance is typically used to protect against large, unexpected losses. Why other options are incorrect. A non-proportional reinsurance is not based on total premiums, but rather on a loss threshold. C. Both types of reinsurance can be applied to any line of business, including catastrophic events and minor losses. D. Both proportional and non-proportional reinsurance can be used across various lines of insurance, including property and life. Question 9. Which of the following best describes the role of the West Virginia Insurance Commissioner in reinsurance transactions? A. To set the premium rates for reinsurance contracts between ceding insurers and reinsurers. B. To review and approve reinsurance contracts, ensuring compliance with state regulations and solvency standards. C. To negotiate terms of reinsurance contracts on behalf of ceding insurers. D. To directly handle claims disputes between ceding insurers and reinsurers. Answer B. Explanation. The West Virginia Insurance Commissioner's primary role is to oversee the reinsurance market, ensuring that reinsurance contracts comply with state regulations and solvency standards. The Commissioner is responsible for monitoring the financial health of insurers and reinsurers, ensuring they have sufficient capital to honor their obligations. Why other options are incorrect. A. While the Commissioner regulates the market, premiums are generally determined by the insurers and reinsurers. C. The Commissioner does not negotiate individual reinsurance contracts, but ensures that terms comply with regulations. D. Disputes over claims are handled through the legal system or arbitration, not by the Insurance Commissioner. Question 10. Which type of reinsurance arrangement is most commonly used to manage risk in property insurance for catastrophic events, such as earthquakes and floods? A. Facultative reinsurance. B. Excessive loss reinsurance. C. Quota share reinsurance. D. Surplus share reinsurance. Answer B. Explanation. Excessive loss reinsurance is most commonly used to manage catastrophic risks, such as earthquakes and floods. In this arrangement, the reinsurer only pays claims that exceed a certain threshold, providing coverage for large, unforeseen losses. This is especially useful for covering catastrophic events where the frequency and severity of losses can be unpredictable. While other options are incorrect. A. Facultative reinsurance. Used for specific, individual risks, not for managing large-scale catastrophic events. C. Quota share reinsurance is proportional and involves sharing premiums and losses based on a fixed percentage, which may not be as effective for large, catastrophic losses. D. Surplus share reinsurance is a proportional form of reinsurance and does not focus specifically on catastrophic events. Question 11. What is the primary purpose of a clause loss provision in a reinsurance contract? A. To define the maximum amount a reinsurer is obligated to pay for a loss. B. To determine the retention amount the ceding company must cover before the reinsurer pays. C. To specify that the reinsurer will pay only losses that exceed a specific percentage of the ceding company's net worth. D. To limit the number of losses that can be covered in a single policy period. Answer A. Explanation. A cause loss provision is designed to specify the maximum amount the reinsurer is obligated to pay for a specific loss or event. It limits the reinsurer's exposure in the event of a large loss and defines their financial responsibility for claims. Why other options are incorrect. B. This describes the concept of a retention limit, not a cause loss. C. Cause loss provisions do not typically depend on a percentage of worth. D. There is no typical limit on the number of losses covered in a cause loss provision. It focuses on individual loss limits. Question 12. In a facultative reinsurance agreement, which of the following is true? A. The reinsurer assumes a portion of the ceding insurer's entire portfolio of risks. B. The ceding insurer can choose whether or not to offer specific risks for reinsurance on a case-by-case basis. C. The reinsurance coverage is automatically applied to all policies issued by the ceding insurer. D. The reinsurer does not have any influence over the underwriting process of the ceding insurer. Answer B. Explanation. In facultative reinsurance, the ceding insurer has the flexibility to offer specific risks to the reinsurer on a case-by-case basis. The reinsurer can accept or reject the offer based on their assessment of each risk, while the options are incorrect. A. This describes quota share reinsurance, not facultative. C. Facultative reinsurance is not automatic. It is negotiated for specific policies. D. The reinsurer can review and approve or reject specific risks impacting the underwriting process. Question 13. Which of the following types of reinsurance agreements is most commonly used by life insurers to manage their long-term liabilities? A. Facultative reinsurance. B. Treaty reinsurance. C. Excessive loss reinsurance. D. Surplus share reinsurance. Answer. B. Explanation. Treaty reinsurance is often used by life insurers to manage long-term liabilities. This type of agreement covers a broad range of risks under a single contract rather than on a case-by-case basis. It provides continuous coverage for a ceding insurer's portfolio, which is ideal for managing long-term risks like life insurance policies. While the options are incorrect, a facultative reinsurance is typically for specific individual risks, not for long-term liabilities. C. Excessive loss reinsurance is often used to cover large catastrophic risks, not long-term liabilities. D. Surplus share reinsurance involves sharing risk based on policy size, but treaty reinsurance is more common for long-term portfolios. Question 14. How does a ceding company benefit from a retention limit in a reinsurance contract? A. It allows the ceding company to pass on all risk to the reinsurer. B. It ensures that the reinsurer will cover any loss that exceeds the ceding company's financial capabilities. C. It defines the maximum amount the ceding company can keep for itself before the reinsurer must pay. D. It reduces the amount of capital the ceding company needs to maintain for solvency purposes. Answer. C. Explanation. The retention limit defines the amount of loss that the ceding company is willing to retain before the reinsurer assumes the remainder. This allows the ceding company to manage its exposure to large losses while transferring the excess risk to the reinsurer. While other options are incorrect, A. The ceding company retains some risk with the retention limit, so not all risk is passed to the reinsurer. B. The retention limit does not refer to the ceding company's financial capabilities, but rather the agreed upon amount of risk they are willing to bear. D. The retention limit does not directly reduce the ceding company's solvency requirements. Question 15. Which type of reinsurance would a ceding company most likely use to protect itself from very large and frequent losses such as earthquakes? A. Quota share reinsurance. B. Excessive loss reinsurance. C. Surplus share reinsurance. D. Facultative reinsurance. Answer. B. Explanation. Excessive loss reinsurance is typically used to protect a ceding company from large and frequent losses like natural disasters. This form of non-proportional reinsurance only kicks in when losses exceed the predetermined threshold, making it ideal for catastrophic events. While the options are incorrect, a quota share reinsurance is a proportional form of reinsurance which shares both premiums and losses across a portfolio of policies. C. Surplus share reinsurance is proportional and does not specifically address large, infrequent losses. D. Facultative reinsurance is used for individual risks, not large-scale events. Question 16. What is the key advantage of quota share reinsurance for a ceding insurer? A. It allows the ceding insurer to limit its exposure to catastrophic losses. B. It automatically covers all risks without any need for negotiation. C. It helps the ceding insurer spread both premiums and risks proportionally with the reinsurer. D. It provides coverage only for specific high-risk policies. Answer. C. Explanation. Quota share reinsurance is a proportional reinsurance arrangement where the ceding insurer and the reinsurer share premiums and losses according to a fixed percentage. This helps the ceding insurer manage its exposure by sharing both the risks and the financial rewards of the policies it underwrites. Why other options are incorrect? A. Excessive loss reinsurance, not quota share, is used to limit exposure to catastrophic losses. B. Quota share does not cover all risks automatically. It is based on an agreed percentage. D. Quota share covers a portfolio of risks, not just specific high-risk policies. Question 17. Which of the following is a disadvantage of non-proportional reinsurance for the ceding insurer? A. The ceding insurer may retain more risk for lower severity losses. B. The reinsurer receives all premiums without assuming any risk. C. The ceding insurer does not benefit from a share of the reinsurer's profits. D. Non-proportional reinsurance can lead to disputes over smaller claims. Answer A. Explanation. In non-proportional reinsurance, such as excessive loss, the ceding insurer retains more risk for low-severity losses, which may not be covered by the reinsurer until a specific threshold is exceeded. This can result in the ceding company assuming more risk for frequent or smaller claims, while their options are incorrect. B. The reinsurer does assume some risk in non-proportional reinsurance, specifically after the limit is met. C. The ceding insurer may benefit from low costs and fewer claims-related obligations in non-proportional reinsurance. D. Non-proportional reinsurance typically applies to larger catastrophic losses, not smaller claims. Question 18. What is typically covered under a run-off reinsurance arrangement? A. Ongoing risks from policies that have already been written, but no new policies are issued. B. A portion of all future policy premiums from the ceding insurer. C. Specific risks tied to a single catastrophic event. D. Risks associated with the underwriting of new policies for a limited period. Answer A. Explanation. A run-off reinsurance arrangement covers risks related to existing policies that have already been written, but the ceding insurer no longer issues new policies. It typically applies to liabilities that will continue to exist even after the insurer stops writing new business, such as long-tail claims. While the options are incorrect, B. Run-off arrangements are not typically used to cover future premiums. C. This would describe excessive loss or other reinsurance for specific events, not a run-off arrangement. D. Run-off reinsurance pertains to liabilities for existing policies, not new business. Question 19. What is the primary function of stop-loss reinsurance? A. To provide coverage for a specific type of loss after a fixed retention amount is exceeded. B. To reimburse the ceding company for losses that exceed a predetermined percentage of its premiums. C. To cover all losses that occur after a specified deductible is met. D. To reduce the number of claims processed by the ceding company. Answer B. Explanation. Stop-loss reinsurance is a form of non-proportional reinsurance where the reinsurer covers the ceding company's losses that exceed a predetermined percentage of its premiums. It is often used to limit the ceding insurer's overall loss ratio and protect it from large aggregate losses. While the options are incorrect, A. This describes excessive loss reinsurance, not stop-loss. C. Stop-loss reinsurance does not cover directly after a deductible. It works by covering losses above a specific loss ratio. D. Stop-loss reinsurance does not directly influence the number of claims processed. Question 20. What is the primary advantage of a catastrophe bond for a ceding insurer? A. It provides capital to the insurer upfront in exchange for future premium payments. B. It transfers the financial risk of catastrophic losses to the capital markets, providing immediate liquidity. C. It offers low premiums for the insurer by shifting risk to reinsurers. D. It allows the insurer to avoid paying claims related to high-severity losses. Answer B. Explanation. Catastrophe bonds are used by insurers to transfer the risk of catastrophic events to the capital markets. In exchange for the bond's issuance, the insurer receives immediate liquidity. If a specified catastrophe occurs, the bond's principal may be used to cover the insurer's losses. While our options are incorrect, A. Catastrophe bonds do not require future premium payments from the insurer. C. The purpose of catastrophe bond, not to lower premiums, but to provide funding for catastrophic events. D. Catastrophe bonds provide funding after catastrophe, but they do not avoid claims. Question 21. What is the main difference between facultative and treaty reinsurance? A. Facultative reinsurance covers all risks within a portfolio, while treaty reinsurance is used for individual risks. B. Treaty reinsurance is an automatic agreement covering specific risks, while facultative reinsurance is negotiated for individual risks. C. Facultative reinsurance is only used for natural disasters, while treaty reinsurance covers all types of losses. D. Treaty reinsurance is non-proportional, while facultative reinsurance is always proportional. Answer B. Explanation. Treaty reinsurance is an automatic and continuous agreement covering a portfolio of risks, while facultative reinsurance is negotiated on a case-by-case basis for individual risks. While the options are incorrect, A. This is the reverse of the correct definition. C. Facultative and treaty reinsurance are not limited to natural disasters. D. Both facultative and treaty reinsurance can be non-proportional. Question 22. Which type of reinsurance agreement is best suited for covering high-frequency, low-severity risks? A. Excessive loss reinsurance. B. Quota share reinsurance. C. Stop-loss reinsurance. D. Facultative reinsurance. Answer B. Explanation. Quota share reinsurance is ideal for covering high frequency, low severity risks because it shares both premiums and losses proportionally between the ceding insurer and the reinsurer. While the options are incorrect, A. Excessive loss reinsurance is better for covering low frequency, high severity risks. C. Stop loss reinsurance covers aggregate losses, typically for higher severity events. D. Facultative reinsurance is for individual risks, not necessarily for high frequency, low severity events. Question 23. What is the retention in a reinsurance agreement? A. The amount of premium the reinsurer must pay for each claim. B. The amount of risk the ceding company retains before the reinsurer's liability begins. C. The portion of the premium that the ceding insurer keeps for itself. D. The maximum amount a reinsurer will cover for any single loss. Answer B. Explanation. Retention refers to the amount of risk or loss that the ceding insurer retains before the reinsurer becomes liable. It is the threshold or deductible that the insurer must cover before the reinsurer pays for additional losses. My other options are incorrect. A. Premiums are not the same as retention, which refers to risk or loss. C. While retention affects the premium, it specifically refers to the risk retained by the ceding insurer. The maximum coverage limit is a separate concept, often associated with limit of liability or policy limit. Question 24. Which reinsurance method is typically used to reduce the ceding insurer's exposure to large, catastrophic losses? A. Quota share reinsurance. B. Surplus share reinsurance. C. Excessive loss reinsurance. D. Facultative reinsurance. Answer C. Explanation. Excessive loss reinsurance is commonly used to reduce exposure to large, catastrophic losses. It provides coverage once a specified threshold or retention is exceeded, making it ideal for mitigating risks associated with rare but high severity events. While the options are incorrect, A. Quota share reinsurance is proportional and typically used for more predictable losses. B. Surplus share reinsurance is proportional but does not focus specifically on large catastrophic risks. D. Facultative reinsurance is used for individual risks, not large-scale catastrophes. Question 25. Which of the following is a primary benefit of using non-proportional reinsurance for a ceding insurer? A. The ceding insurer does not need to share premiums with the reinsurer. B. The reinsurer only pays after the ceding insurer incurs a loss above a certain threshold. C. The ceding insurer must pay all claims below a certain threshold. D. The reinsurer covers a fixed percentage of every policy's losses. Answer B. Explanation. In non-proportional reinsurance, the reinsurer only pays for losses that exceed a predefined threshold, such as an excessive loss arrangement. This allows the ceding insurer to manage exposure to catastrophic losses. While other options are incorrect, a non-proportional reinsurance still involves premium sharing, though it's based on the amount of risk assumed. C. The ceding insurer retains losses up to the threshold but pay all claims. D. This describes a proportional reinsurance model, not a non-proportional one. Question 26. Which of the following is a common feature of a surplus share reinsurance arrangement? A. It covers only large, infrequent losses. B. The reinsurer takes on a fixed percentage of each individual policy's losses. C. The ceding insurer retains all premiums for policies it underwrites. D. The reinsurance agreement applies to a specific catastrophic event. Answer B. Explanation. In a surplus share reinsurance arrangement, the reinsurer takes on a fixed percentage of each individual policy's losses, typically exceeding certain amount. The ceding insurer retains the rest of the risk. While the options are incorrect, a surplus share reinsurance is not specifically for large, infrequent losses. It applies to individual policies. C. The ceding insurer shares both premiums and losses in surplus reinsurance. D. Surplus share reinsurance does not apply to specific catastrophic events but to range of policies. Question 27. In a reinsurance agreement, what is the ceding commission? A. The amount the reinsurer pays to the ceding company for taking on the risk. B. A percentage of the premium that the reinsurer pays to the ceding company to cover acquisition costs. C. The percentage of premium the ceding company must pay to the reinsurer for coverage. D. The fixed amount the reinsurer must pay for every claim that exceeds the retention limit. Answer B. Explanation. The ceding commission is the percentage of the premium that the reinsurer pays to the ceding company to cover the acquisition costs, administrative expenses, and commissions for procuring the reinsurance contract. While our options are incorrect, A. The ceding company does not receive payment for assuming risk from the reinsurer. C. The ceding company pays premiums, but the ceding commission is a payment to them, not from them. D. A amount for every claim would be part of the reinsurance terms, not the ceding commission. Question 20. What does solvency capital refer to in the context of reinsurance? A. The amount of capital the ceding company must maintain to cover future claims. B. The funds set aside by the reinsurer to pay for future catastrophic losses. C. The capital required by regulators to ensure an insurer can meet its obligations. D. The premium payments made by the ceding company to the reinsurer. Answer. C. Explanation. Solvency capital refers to the capital that an insurer or reinsurer must hold to ensure that it can meet its liabilities and obligations, especially in cases of unexpected losses. It is typically mandated by regulators to maintain financial stability. While the options are incorrect, A. While solvency capital can cover future claims, it is more specifically designed to ensure that the company can meet all of its financial obligations. B. Funds set aside for catastrophic losses are typically part of reserves, not solvency capital. D. Premium payments are part of the income, not the solvency capital. Question 29. What is the primary purpose of a retrocession agreement in reinsurance? A. To transfer risk from a reinsurer to another reinsurer. B. To allow the ceding insurer to retain more risk. C. To increase the ceding company's profit margin on policies. D. To provide the ceding company with additional underwriting resources. Answer A. Explanation. Retrocession refers to a process where a reinsurer transfers some of its risks to another reinsurer, called the retrocessionaire. This helps the original reinsurer manage its exposure to large losses. While our options are incorrect, B. Retrocession involves transferring, not retaining, risk. C. The goal is not to increase profit margins, but to reduce exposure to risk. D. Retrocession does not relate to under resources. It is a risk transfer mechanism. Question 30. What is proportional reinsurance? A. A type of reinsurance where the reinsurer shares the risk and premium in proportion to the amount of risk assumed. B. A reinsurance method that covers only high-severity losses. C. A policyholder's insurance coverage that proportionally adjusts with the insurer's premiums. D. Reinsurance method that only applies to specific high-value policies. Answer A. Explanation. Proportional reinsurance involves the reinsurer sharing both the premiums and the risks of the policies in proportion to the amount of risk they agree to take on. This model ensures that both parties share in the losses and the rewards. While the options are incorrect, B. This describes excessive loss reinsurance, not proportional reinsurance. C. Proportional reinsurance refers to the sharing of risk and premiums, not policy coverage. D. Proportional reinsurance is not limited to specific policies but can apply to entire portfolios.